morning, everyone, and welcome back to this new Volatility Corner session with Ryan. Welcome back, Ryan. Glad to have you here. It's been a couple of weeks. Last time was really interesting. We talked about option pricing. Today, there's going to be some interesting topic. We are seeing earnings of three of the Max 7. Apple is reporting today. So, yeah, excited to see what you have for us. I think you're on mute.
Yes, absolutely. Thanks for having me back as always. So today, we've got some exciting earnings, a few things to look at in the market. We'll try to dig into some more details about some of the strategies that we talked about 2 weeks ago, how you can kind of re-own a tail to protect yourself with your strategy. And I brought some visualization tools that we've used for some of our classes in the past. If people have questions about understanding the Greeks a little bit better. As a reminder, please feel free to put your questions in the chat. We'll try to answer as many as we can. If they get into a more complex strategy or something that's going to take a little bit more time, then feel free to email us and or with any other questions. And for anything more complex, we'll try to review it and have it ready to discuss in the next Volatility Corner. So without further ado, let's jump in and do our market roundup. Of course, we saw some earnings today, so you're going to expect to see, the place I always like to start. I like to go to so this is yesterday's end of day. And let's go ahead and start with, normally I like to do the total market, but let's just look at a few of the companies that we know that announced today. So first off, we have MSFT. Refresh that. Sometimes this ticker gives me, there we go. So we'll look at their term structure. We saw Microsoft just announced. So look at that volatility there coming in, right? Super high short-dated volatility, which pretty quickly declines back towards not low volatility, but fairly low for a tech stock, given how much uncertainty and kind of excitement there's been around tech stocks over the last 5+ years. So you can see this, and this very clearly tells us that earnings were coming out. But look how 5 days ago there was this spike. So, people did not think we were going to be volatile leading up to it. Not at all. They weren't willing to pay a premium, but they were starting to pay a big premium. And as we got closer and closer, the single day options jumped up here to, 90% implied volatility. So if you have a view on these things, it can be a really good way to express it. So for example, like if you were bullish Microsoft coming into today, you could have probably hedged, pretty nicely. So for example, if you wanted to buy Microsoft stock coming in and sell like a 0 DTE call coming into today, we can roughly estimate here what Microsoft's, so if MSFT, now of course that wouldn't have worked so well for you. Microsoft's down over 11% right now, but let's see how that could have at least reduced your losses and helped you manage some risk. So, if we're coming into today around, we came in around, let's see here, we would have come in around 475, 480. So if we came in at 480, we were looking at the 480 underlying, and for 0 DTEs, we don't need to worry about interest rate or dividend for close approximation. And it was expiring. Here, we'll do a 1 day from today. So 1/30/26. And if we were looking at, let's check here, a 480. So let's just say that you wanted to sell a call at 90% implied volatility, you were thinking about selling, I don't know, you thought that Microsoft should go 10%, 5% higher, right? So then you could do equals this times 1.05. So if, let's say we wanted to sell the 505 call. So you bought Microsoft coming into earnings and you were hoping to, capitalize on that. You could have sold that call and gotten $1.66. So that's actually not great for a one-day option. So that wouldn't have really protected you a whole lot, but it would have cut, a little bit of the pain here. Oh wait, sorry. Yeah, 480 and a 505 call. And let's double check here. And now let's go see what I'll go check live what the current Microsoft calls and puts are trading. Yeah, so that at the money call though, I mean, it still had, so now the at the money is more like $4.50, $5. So there is pretty meaningful value there if you're willing to trade at the money. Yeah, look at that drop off. So for the 0 DTE, it would have been worth $9. So the question there would have been to figure out like how much upside you wanted and were willing to give up. So it looks to me like, and now the at the money is worth about $4.50. That's how much volatility's come off. So I don't know if we can get live intraday here on Microsoft, but let's try it. Let's see if we can see, we saw it was up to 90% coming into the day. There we go. Doesn't look like we can pull in the updated term structure.
No, not under the intraday yet.
Okay, got it. So we'll go back to end of day. But we can estimate that roughly the 0 DTE using an options price calculator. Let's see. So I can tell you that currently the 425 versus 425 is currently trading at 455. So we're probably down to, here's the price right here if you're following along. So there we go. Volatility is down to about 52%, 51%, down from 90% coming into today. So that's a pretty significant, drop in volatility, but it's still pretty high. So, if you wanted to trade it, there might be an opportunity to trade for a bounce back or something. But, I think you can see how, coming to these earnings plays, if you have a directional view, you could really get, juice your returns, or, you could get leverage. It's really all about playing how high the implied vol is and how big you think the move could be. So it looks like 90% vol, frankly, was not high enough volatility for Microsoft for today, because a 12% realized day is still going to be outside the break even. But, I would, I'd personally look at strategies like this when you have a view coming in is, can I sell a call, sell a put when vol gets really high, and vice versa. If you think it's pretty cheap for a move like that, you can actually trade the call or the put to protect your tail. So if you were buying Microsoft, you could look at buying the out of the money call. We can estimate going in what that would have cost. So if we were looking at this yesterday, if we were looking at buying a put to protect ourselves because we were bullish, you know, maybe 20 bucks out of the money, that would have only cost 220. So effective break even around 458. So you'd have been able to save yourself $25 there, give or take. You know, we're currently trading around 425, and you'd have locked in floor 458. So that's funny because I would have thought at 90% volatility, oh wow, you know, seems like a great sale, but you know, it turns out it would have been a pretty good deal to buy to protect yourself with a way out of the money option there. And vice versa, if you short stocks, I know, you know, fewer retail investors short stocks, but you could have kind of done the same thing in reverse. You know, if you would have bought like an out of the money call, same deal, you know, it would have cost 250 and you could have shorted it. So if you were bearish coming in, you know, you're effectively paying away 250 to put a cap on. The most you can lose is 20 bucks. And then you'd be making the full 60, you know, $57 sell-off that we've got today. So I don't know if there's questions about that, but you know, that's there's just a lot of things to do when you get into these earnings. But you really want to have a view. I don't think you know, volatility will ever be an answer by itself when you're talking about an earnings announcement specifically, right? Because you can see 90% volatility is outrageously high implied volatility, and yet not nearly high enough to price in the move today. Because options, you know, 20 bucks out of the money on Microsoft were, you know, just a couple dollars, and we've blown through those, right? Like we're a $45 move. So I would say those options were underpriced in retrospect. So what volatility would have been right? I don't know, 140%, 150%. Like what would it have, you know, taken to have priced that more fairly? You know, if we wanted to look at like what the 430 put. I mean, even at 200% volatility, it was really cheap. So if you know, obviously nobody knows, at least not those of us who are trading on public information. But if you have a strong view on the market, you know, I guess even at very high volatilities, it can be reasonable to buy options. But you know, then these are out of the money options, tails. This is why I always tell people, like, re-own your tail, buy the tail. It might, you know, seem like you're giving up a lot of your return, but it's really not that much money in the scheme of things. Because if you just traded the at the money option, you know, and had a view around that when we were at 90% vol, could have picked up 9 or 10 bucks. Now, obviously, if you sold the put, sold an at the money put, you'd still be out, you know, 30 or 40 bucks, but you'd have made a decent amount of premium. And if you sold the call, you know, you'd be doing great. You'd be basically have your 9 bucks nearly locked in now, because that call option would be worth what, like 425. It'd be worthless now. So, you know, you'd basically made your whole 9 bucks, and you could lock it in with no risk for the rest of the day, or de minimis risk. So we'll go back to our review of markets. But again, just, you know, you can keep an eye on these things around earnings, and just get used to understanding how implied volatility kind of moves and evolves through the course of a day or a week, particularly around these big earnings announcements and earnings surprises. So we saw Microsoft jump up to 90% from 30 up to 90, and now it's coming back down to 50, and it'll probably pretty quickly here revert back to 30 in the next couple of days.
Ryan, maybe we can go over Apple, given that we are
Yep.
This afternoon we are going to see earnings. That could be an interesting use case.
Yes, absolutely. So yeah, we got the same story for Apple. And again, like you get used to if you look at these term structures, you know, every day or every week, you'll very quickly just recognize that story that they're telling you. Very similar story to Microsoft, long-term volatility around that 30% level. A week ago, short-term volatility, people were not paying a premium for it, but they were already anticipating this earnings announcement, of course, because the market's pretty efficient. So they saw earnings upcoming, and so longer volatility was higher, and now we're here. Now a week has passed, and so we're up here at 65% volatility, lower than 90. So you can see that people a little less worried about Apple, being impacted by their earnings announcements. And I think a lot of that has to do with the fact that so much of Microsoft's value right now is driven by AI, and there's a lot of uncertainty around the cloud capacity, data center build-outs, et cetera, and compute that's provided for that. Whereas I think Apple's business a little bit more stable. They obviously are exposed to all this, but more into the kind of retail, so they've got a lot less fall, but still we're talking about what on paper sound like high numbers. So you can look at the technicals coming into days like this. We always talk about, and real quick here, we'll check out the smile and see if out of the money, if puts versus calls, if there's a big difference. Not really here. It's pretty symmetrical smile. Hold on, let's check where price we were trading, 256. Yeah, so this is a pretty symmetrical smile. The puts are a little higher than the calls, but we've talked about that before. You almost always expect puts to be a little bit over calls in the stock market, because most people own stock, and so if they can buy cheap puts as protection, they will. Plus, of course, when the market falls, people tend to get more panicked and volatility goes up. So we almost always expect to see puts over calls, but sometimes this smile gets very extreme. So you might see stocks where the put wing looks like this, but the call just keeps going down, like down to 25, 30%. And that's not the case here. We're seeing, pretty big volatility, or, what I would call these almost symmetrical wings. There's a little bit of a gap here saying, like, if we just march up from 256 to 300, we're not seeing volatility get high, but then it'll pretty rapidly pick up again. So you got pretty good symmetry. I don't think we have a one-day skew measure. I don't think
we have a 0DT skew. So if you go on add command.
Okay, let's do it. Let's check out what the
scroll down, and you have
there we go, 0DTE skew. I don't normally look at that one because its skew can be unreliable, but I think for earnings days this is invaluable. So let's check out the 0DTE skew. Oh, pretty much right down the fairway. So what this tells you, and you can see this, so the puts are a little bit over the calls. This is really symmetrical, and so again, the market's not really handicapping a big move one way or the other. So I'd say that the nice thing is, if you have a view on Apple, you're not really going to be punished, or if you're looking to trade options around it. Like, let's say you were bearish. A lot of times we go look at the market, the put skew is really, really high. And it's like, well, I'd love to buy puts, but you're paying a big premium for that put, for that right to protect against the sell-off. And so, it can be hard to justify. But in this case, you're not really seeing that. Of course, all volatility is high, as we talked about. But if you get anything like a Microsoft move, then, don't be shocked if that vol ends up seeming small in retrospect. If you're looking to trade 0DTEs or one day options, I guess would really be the thing you'd be looking for if they come out after market close. So if you're looking at for the Friday option expiry on Apple, if it's pretty symmetrical and you think that we could get a big move, I think those teeny options, the low delta options, can be pretty reasonable. Let's just throw in a couple different prices and see if we can. Let's just, checking this out. So if the skew runs like 20%, as we get out there. So if we want to look at like 20% skew, here I can get actual options prices to check this. But now if we want to look at like AAPL, underlying price of 520, 256. Okay. So just starting off with, we'd expect an at the money call at 60 vols to be worth about 3.2. Here, let me make this one bolder so you can see that. So we expect it to be worth about 3.2. And I'll go check that on my brokerage off the screen here. So if we put in AAPL, look at a put, at the money put expiring the 30th. Yep. Oh, I actually get $4.50. So it looks like the 1 day is even a little bit higher. So it looks like that volatility is trading closer to 70, 80%. If we look at the money. Oh, wow. Yeah, maybe 82% is kind of my latest run. So I guess volatility's picked up a little bit today. So we were looking at the end of day for Apple, right? So what we can see is that volatility is actually rallying today. And I'm guessing with the big moves from Meta up 10%, Microsoft down 12%, that people are starting to think that this Apple move could be bigger than they had probably priced in. So we can get some rough estimates. Of course, you're welcome to price these on your own at your own brokerage site, but we can get some just general estimates for where volatility might be out of the money. But to start with, we're looking at about $4 for an at the money option, and that'll be the same whether it's a call or a put. Shouldn't change when you're talking about an at the money option. That's not quite the case as you move out in time because you got things like dividends and interest rates, but over a day, that's not really going to matter. So, at the money is around $4.50. If you think that the move is going to be more than 4.5, you should look at buying options. You could, if you have a view on the direction and you think it's going to move more than $4.50 lower, for example, you could buy that put. If you're not sure, but you think we're going to move large one way or another, you can buy the straddle, of course, which would be the same as buying the call and the put, right? And that's going to be the exact same here. We're buying the call and the put, so the price is going to be the same. So you're going to expect, but you're going to be paying $8.87 for that. So you're going to be, you need the market to move more than $8.80 if you don't have a directional view to cover the price of your straddle. Alternatively, if you think that the market's going to move less than $8.80, you can look at selling the straddle. And as long as the move tonight, tomorrow is less than $8.80, you'll make money. Quick reminder. For those of you who like the hockey sticks, I kind of find these nice and intuitive. So the long straddle, so that's the long straddle. So if you buy the straddle, you're going to be losing money here in the red territory. This is where the market starts, and this is how much it moves. If it moves outside of this band, then you're going to start making money. The more it moves, the more you make. If it stays inside this band, you're going to be losing the premium. And if you sell the straddle, it's going to be the exact opposite. It's going to be a upside down V, and you'll be making money inside here, losing money outside. And again, feel free to ask questions if somebody's got a view or on one of these stocks coming up with earnings. I'm always happy to talk through how we can trade it. Next, let's look at a few of the teeny options for Apple and see what happens they'll have some skew, but even So let's assume that vol goes up to 100%. If we price an out of the money option, something like 290, or sorry, about like 220. Wow, even the 235, 240. So you could, I mean, if you thought it was going to be a really big move, it's still almost nothing to buy a 240 put. Now, that being said, that's pretty far away. The call, on the other hand, you're not going to have as much skew. I think we looked at that. In that 300 range, it was pretty light. So I'd assume skew is more like 90%. So if we wanted to look at, say, like the 275 call, so you can see that these out of the money options are, like, just like we said before, and this is the thing about zero DTE. I'm used to trading longer dated options, so I don't tend to look at these. But even though vol is very high, the out of the money options, their delta is so low, meaning that their probability of being in the money is so low that even with very high volatilities, they can be, pretty surprisingly cheap. And so, this is a good time to look at a strategy, right? Like, let's say you're bearish, you want to buy that put, or sorry, you want to sell. Let's say, so you want to sell a call. We saw that you can get pretty good money for this call, right? If you wanted to sell, say, the 256 call, because you're bearish Apple at 440, so you're looking to collect $4. So if market goes up tomorrow, more than $4, you're going to be out of luck, right? But what happens if it goes up 10, 15, $20? And you could lose quite a bit of money, as we're seeing, like with this Microsoft move. So a thought, an idea would be to buy back this other, this out of the money call. So maybe look at like the 270 or something cheap. 266. So if you do the 266, you could collect $3. It's less than 444, but now your risk is limited. The most you can lose is $20. We can also do some pretty fun probability math. So the market's basically telling us that $20 you can make 3, or if you wanted to buy that call spread, it cost you 3. So 3 out of 20. So probability right there of going higher, about 15%. About a 15% probably. That's a rough approximation, but there's about a 15% chance that we go, significantly higher, that we go to 266 tomorrow for Apple stock. And you can do that if you're curious about any probabilities in the market. This is one of my favorite thing about options, is to be able to see what the probabilities are that are implied. And you can do that by just looking at a call spread or put spread for any price strike. So let's say you asked, what's the probability of Apple falling to 225 tomorrow? So we could put in So that's a pretty small, 225. So we could look at, say, 226 and 225. We'd have to do a little math here. So we'd have to take the difference in the two premiums and divide that by $1. So this over $1. The reason is because the difference in this put spread is $1. So if you buy the 226, 225 put spread, you're going to make $1. It only costs you a penny to do that. So the market's saying there's a less than 1% chance we'll close tomorrow at, less than 1%. So pretty tiny chance. If you thought there was a chance that devastating news was going to come out, you thought it was higher than 1%, you should look at buying, put spreads, out of the money put spreads or puts. And I'll give a quick check here and see what the actual market is telling us for Apple. Let's try the 226, 225. See about a nickel, 5 cents. And yes, I plugged it into my brokerage site and got identical numbers, 1%. So about a 1% chance of Apple absolutely tanking tomorrow. And we can play the same game with, much higher prices. So we could try something like 235, 230. And, the difference there is going to be 18 cents. Instead of divided by 1, we would divide it by the difference in the strike. Yeah, about a 3.5% chance, 3.6% chance of Apple falling to 230 tomorrow, and we can just keep going. So, yeah, so it's like, let's try 245 versus 240. 18% chance now. Let me put this in percentage. So 18% chance of getting down to 240, to 242.5. If we keep walking it up, 250, let's try 250, 249. 32% chance of getting down to 250. So once you get one of these calculators set up, you can really play and start to understand exactly what the market's telling us about probabilities, and then you can start to connect that with your, with your view. So, for example, if you thought that the probability was much higher, you should consider buying some of these options, and vice versa. If you think the probability is much lower, you look at selling them. And just collecting the premium. And you can even sell them as kind of an offset. So if you wanted to get short Apple because you were bearish, but you didn't think that it could fall that much on one day's news, you could look at selling one of these put spreads, and then you'd add a little premium to your short. Okay, so we talked a lot about trading around these strategies. I don't know if there's any other questions with Apple right now. Your probabilities apply to the risk neutral world. That's not accurate. I'd love to have that discussion. I think that's a really interesting point. It's not really saying that those exactly are the probabilities, but if you disagree with that, I mean, there's quite a few things you can do, right? Like you can still trade around those probabilities. So they still work as pretty good approximations. I mean, they kind of have to be the right probability in the sense that if there's not, you do those trades. Of course, you have to build in things like cash and drift, but they tend to be good enough for approximations. So most options traders kind of still use those. And there's an ongoing debate, always, amongst options traders, I would say, in terms of, and different strategies of like, how much do we think about options prices being a function of implied volatility and kind of assume that people are trading this, and there's not an actual probability of a certain move. And then how much do we think about these, like there's not a bias in the expected move, versus how much do we think about real world events driving them? And the funny thing is, in my experiences, Nevin, is that they do actually tend to kind of balance out between those two. So, for example, I've looked at put spreads on like the S&P 500, and you'd think to yourself, well, like if we look at those probabilities, they shouldn't really be based on historical. They should be based on implied volatility and how delta, like how much people need to charge to cover their delta hedging if they're a market maker. But interestingly, what I saw was when I was pricing in put spreads on like betting on a crash or a big sell-off, those put spreads I was looking at were kind of like 1 year put spreads were kind of like 1 in 10, 1 in 15, which worked out very closely to the frequency of bear markets. And so again, while I agree with you that it's not strictly speaking accurate to say that probabilities are only only correct given us a few assumptions, the actual kind of efficiency in the market tends to work out that the implied probabilities of these options trades do tend to line up with some historical reality. Now, maybe those were wrong probabilities, but it's very difficult to say if we're right or wrong, because in practice, right, the market's constantly moving and we only have one world. So we only get one play of the game, i.e. we can say, well, a 10% probability makes sense of a market crash or big sell-off, but who knows? Because if the market doesn't crash that year, you don't know if the probability was really 10% or 20% or 1%. So, we kind of switch from a probabilistic world to this deterministic world. And again, but keep the questions coming. I love it. Where can you get such a calculator? We've talked about how to build those in the past. I've taught classes. You can just Google Microsoft Visual Basic, Black-Scholes code. So you can always just try that. You can just say, Black-Scholes VBA code, and you can drop it into your Excel. I'm sure ChatGPT can just give it to you. But I also occasionally teach classes, and when we do a class, we'll talk about it. If you open up your developer ribbon in Excel, and then go to Visual Basic, you can get those. Probably don't want to screenshot those because it'll be a pain to retype it, but not rocket science. These things are well established, so you can go grab the Visual Basic code right off the internet, throw it into your Excel VBA, and get it going. I had to use quite a bit of tuning to get it just how I liked, but the possibilities are pretty endless if you're willing to spend the work. Like you can start to visualize different things like the payoff profile. Last week or 2 weeks ago, we started talking about some really interesting trades. I was telling people, look at buying long dated options, because with long dated options, they seem more expensive, but they also hold on to their value. So you have a pretty good chance to sell those options before they expire, like just partway through their life, and retain a lot of your value. So one of the examples that I gave 2 weeks ago, and a strategy that I've been working on, is NVIDIA, just kind of owning some tails on that. So I've been owning something like the 130, I think it's the 135 tail. Oops, that's the strike price, 135. Underlying price on NVIDIA, about 189. It was 185 when I bought it though. Implied volatility was such that let's see, so I got a year out. So I bought it a year. So we'll just do a year from today. So we look at 129.27, and we go minus a week. That's charting delta right now. We want Y to be equal to the options price. There we go. And with volatility, something like 40%. Let's try 50. Nope. I think it was like 41. Yeah, so I was able to buy it wasn't closer to 41. So I was able to buy the 135 put on NVIDIA. Obviously, this doesn't have an interest rate, but so I guess volatility was a little bit higher. No. So it was right around there. So volatility was around 45%. I was able to buy a 1-year option on NVIDIA, pretty far out of the money, mind you, $50 out of the money, on for about $8.30. That was about where I bought it. And you might say, well, that's really expensive. I mean, what are the chances that NVIDIA is going to go below 135? Falling $50, that seems pretty crazy, right? Like a 40%, 30% sell-off. But my approach wasn't so much that I expect NVIDIA to fall that far. To the contrary, it's that I was selling puts. these 0 DTE at the money puts, and I wanted to minimize my risk. So I'm typically selling these puts, sorry, not 0 to 1 week. I'm selling the weeklies, and typically I can get anywhere between $1 and sometimes more than $2 for one of these options. And it sounds great. But of course, the problem is how much can it go against you, right? Like NVIDIA can easily move $5 in a day. In fact, just looking at today, they've got earnings coming up not too far. Today they've only moved $1, but you can just see them. They swung $6 today. So at $2 0 DTE, I mean, it's good money, but it can certainly go against you, and it can go against you pretty hard when it goes against you, right? And so the thing that I've been, trying to think about is, how do I protect my risk? What if I'm short puts on NVIDIA and the AI story gives out? I don't want to lose everything. And so, for me, it made sense to cap my losses and buy a put that was roughly like 30% out of the money. But here's the beauty of this, right? So the way that I did this trade, it takes me about 4 to 6 weeks to pay for my tail. And what I mean by that is once I reach that tail, any profits thereafter are not risk-free, because I can still lose down to the tail, but I didn't, I've paid for that cap. So then if the market just keeps going up, then, everything else is profit. So that was kind of the way I looked at it. But then here's what I think is really interesting is, this is weekly. Oh, the x-axis is time. So if we look at this over time, right? So this kind of is an approximation of how much time will pass as weeks go by, as how much the option will be worth. So if the option was expiring in 5 months, it'd be worth $3. But if it's a year, it'd be worth about $8. So if I were to say roll this option in about 6 months or get out of it because I was tired of the strategy, how much would I actually be out? So 6 months from today, about 7. I could probably get out of this option for somewhere around $4. And if I were able to sell this option for $4, I'd really only be out $4. So my cost of owning the tail, pretty reasonable in my estimation, about $4 to own the tail. Additionally, if volatility were to go up in that time, so if it starts at 45%, but if the market sells off a little bit or people start to panic and volatility goes off, you can't see where I'm writing this, but let's just say it goes up to 55%. So what I'm doing there is saying that implied volatility jumped in the future. Look, I could actually end up recouping most of my expense. I could potentially get out of this thing for $5 or $6. So suddenly I would have owned. So this is, and you might say, well, sure, of course, if you buy options, then volatility goes up, you make money. But there's a good reason to think that that will happen, and I'll show you why. And that's because of curves like this. See how as we get closer in time, sometimes the volatility goes up, sometimes around events. And so like if we look at NVIDIA, I was able to take advantage of the fact, a lot of times you roll up the curve here. And so some of these, you can't, it's a little faint right now, but there have been a number of opportunities as we get closer to earnings where the whole thing kind of spikes 3, 4, 5%, and it starts sloping upwards. So when you see these upward sloping volatility curves, you have a decent chance that volatility will actually increase over the life of your option. And so, you got a couple ways that you can win. And if you recall, 2 weeks ago, I was telling everybody, hey, you should consider buying options on SPX to protect yourself or reducing risk. And that's kind of why, because if you look at S&P volatility, we are actually up a little bit. from when we talked about it, but not much, only about a percentage point. But a week ago, you would have had a nice chance to take profits. So if you bought like medium term options, like 1 month options, when we talked 2 weeks ago, most likely your option would have rallied pretty soon. You would have been able to make money on that option, even if the market didn't move. So this is, again, great example of how you can make money on long options. I'm focusing on long options today because so many people, even I have family members who I teach about options, and they go, I hate to pay premium. I really don't want to pay premium. And I'm not saying you should all go buy options, but we should understand that paying premium it's not like we're just losing that money all the time. So if we look at SPY, right, it's at 690, and where was it? It really hasn't moved, right? And so it's been chopping around 690. So if you sold a 690 put on SPY, let's just do this real quick. So if you did like a 60-day put, and then let's say that was more like 30 days. Say we did a 30-day and now it's a 20. Let's say we did a 30-day. Now it's a 20-day. So if we traded the 690 put, and it was at 13% vol, no, it was even cheaper. If you bought that around 10% vol, 11% vol, and then 5 days ago, when it got down here, it kind of spiked up to 13%. So we lost a little bit of money on that, and that's because these are shorter dated options, so they don't have quite as much vega, but you didn't lose a lot in that time period, right? Because it stepped up. And so you made up for the fact that, so you'd have lost $3, but because of that gain in volatility, you only lost $1.60. So that really can protect you as well. So that's why we kind of say when volatility is cheap, owning some longer term volatility, you can always get out of it, right? And so again, as you know, we kind of did today's call in reverse because we wanted to focus on earnings, but same story as 2 weeks ago. Volatility is very cheap now. The risk is to the upside. Will it go up? Who can say? But the risk is definitely to the upside. And so my bias would be towards being long options, particularly on the kind of medium part of the curve, so that if we get one of these spikes, you can make money, or at least be flat. And if the market moves in the right direction for you, then you'll definitely make money on that trade. So I definitely like leaning towards that. And again, as I always say this, that doesn't mean go out and buy options if you're not used to buying options. But if you do buy options, it means that you can kind of increase your risk allocation. You typically an option seller, I would be reducing my option selling, kind of my risk right now, or owning tails, right? We talked about that. If you sell short dated options, go look at owning that long-term tail to cap your risk. Going back to my NVIDIA example, when I cap my risk at 30%, or 35%, you might say, well, oh yeah, but that's never going to happen. Well, that's true, but then I can do more of the trade and more confidently because I know exactly how much capital I'm risking by being short put spreads rather than puts. And so I can end up actually doing more of the trade because I'm not running, unlimited risk. Because I don't think NVIDIA is going to fall 100%, but crazier things have happened, right? We've had Enrons, we've had companies drop 60, 70, 80% or go bankrupt. And so, again, if you want to benefit from from trading volatility, makes sense to re-own that tail when you're selling vol. So again, right now, I would especially recommend, if you don't want to stop selling short-term volatility, trying to look to own cheap tails. So real quick, we'll kind of walk through again. I don't think there's been a lot of change. The markets have been pretty quiet over the last 2 weeks. There is put bias, though, creeping into the market. So I do think that there's some people getting nervous out there. And that just could be because with earnings coming in, that more people are worried about bad earnings and something that could put a dent in the AI story. Because ultimately, so much of the market strength over the last couple of years has come from the AI stories. So anytime there's doubt about that, I would expect this put bias to creep higher. Which is interesting, right? Because that goes back to that kind of comment about probabilities. Does that mean the probability of a sell-off is higher? Not really. It could just mean that, people are worried about the change in volatility if we go down there. And they're just willing to pay a premium for insurance. But regardless, what it means is there can be a trading opportunity. So if you don't think that's the case, you can look to sell those puts. Or if you're looking to short the market or bet against the market by buying close to the money puts or selling calls, then you could also sell. Then you could look to buy that put or sell that put. Depending on how you feel about the probability. So last thing before we wrap up, I just want to peek at, again, it's tough to trade these markets when we're just kind of chopping here. You've got to be really selective. Individual stocks, trade around earnings. There's not like a huge market story because the broader market seems to be averaging out a lot of these individual moves. You got Microsoft down 12, Meta up 10. Who knows what Apple will do, but a lot of these things tend to average out, and the actual SPX has been pretty boring, chopping around 690 with volatility not getting exciting. Other than this put skew, there's not a lot we can say about it. When we look at, we can look at the Qs. They'll be a little bit more interesting because of all the earnings coming out. But even so, they do tend to balance each other out quite a bit. So we've had a nice pickup in volatility from where we were a month ago. But even so, these are pretty low vols for the Qs, given everything that's going on. So the last thing, like I said, we're kind of going in reverse. This is usually where I like to start, is to look at my volatility models. And check this out, the volatility risk premium, and see if anything's jumping out. Again, I've said that this is a challenging environment when realized volatility is low. These look so attractive because they're not moving, but it seems like they will start to move. The only one that's jumping out to me is gold. I'm just not as familiar with XLP and SLV. Oh, well, silver, of course. So gold and silver definitely have a story, I think, to trade there. The challenge there is, you got to have a view with gold prices. They continue to be supported and marching higher. So it's tough to figure out if you're going to bet against it. Maybe selling puts, though, could be, if you're getting concerned that gold's running out of steam and you wanted to lighten up but not get out entirely, maybe sort of some sort of selling put spreads would be a way to get exposure to gold rallying. With a little less risk than just outright buying gold. Could definitely be an opportunity because, again, that volatility is high. So it's all about finding the right opportunity there. But yeah, like I said, I'd stay away from shorting vol on these two names because realized vol has a tendency to bounce. So yeah, there's not a ton going on in the market at the macro level right now, but there's so many selective opportunities. And so on the next volatility corner, please, let us know if there's some particular opportunity you want to talk about, if there's some individual stock or earnings story and how we could build a trade around it. If there's no other questions, everybody, happy trading and good luck with earnings.
Yeah, thank you. Thank you so much, Ryan. This was super helpful, and we'll be back in a couple of weeks with Ryan. And yeah, please, guys, if you want to learn new things and if you want us to cover Uh, any specific topic, please send us an email at info@mentorq.com, and we'll make sure to listen to those feedbacks. But I think this was great, and thank you again for your time, Ryan, and speak to you soon.
Great. Thanks.